All right. Got a couple housekeeping items to go through here. Hello, everyone, and welcome once again. We're thrilled to have you join us for today's webinar on financial planning for engineers. My name is Chris Cotton. I'll be your host today. But before we dive in, I'd like to go over, as I said, a few housekeeping items. I want to let you know that this webinar is being recorded. Both the recording and the presentation slides will be shared with you after the session, so no worries if you miss anything. You'll be able to revisit later. We've turned off public chat for this session to help us moderate more effectively, but you can still engage through the Q&A feature. If you have any questions during the presentation, type them there and we'll get to as many as we can at the end in a little Q&A session. For those of you who are licensed engineers, you'll be pleased to know that attending today's webinar qualifies you for 1 hour of Area of Practice Continuing Education. Clarity Wealth, that's us, is an FBPB approved continuing education provider. To receive that credit, you'll need to complete a brief quiz that we'll send you after the meeting. Once you submit it back to us, we'll get you that CE. And to get things started, a little fun thing. If you could be anywhere in the world right now, perhaps not getting rained on or hurricaned or any other natural disaster, where would you be right now? Throw their responses in the Q&A. Where would you be, Stephen?
I would be somewhere cold. I walked out today, it was 68 degrees, and I was like, oh, this is going to be wonderful. It's finally cool off. Now, humidity was 98 degrees, so it was still muggy and hot, but somewhere where it's low, humidity's low, somewhere where it's cold. So somewhere north, I don't have an exact place in mind, but just cold.
Yeah, when we get those hot summers, I just start daydreaming of Montana, I think.
Yes.
Wide open space. And speaking of Stephen, it is my pleasure to introduce the speaker, who is Stephen, a licensed civil and structural engineer and an authority when it comes to financial planning. Stephen's going to be walking us through the key elements that everyone needs to consider when planning their financial future. So nothing else on the docket, no further ado, all the pomp and circumstance out of the way. I'll hand it over to you, Stephen, to kick us off.
Awesome, Chris. Thank you so much. I appreciate it. And everybody that's here with us this afternoon, thank you so much for giving us some of your time. If you are in Florida, I know there's a lot going on with storm prep. We're making sure that family and friends are okay. So we want to be cognizant of that. We're keeping everyone in our prayers, and we don't know what's going to happen, but going to be prepared as we can for that. I'm going to go ahead and share my screen. Chris, if you could just let me know that you are seeing this, that would be wonderful.
Yep, all good.
All right. Yep. So what we're going to do today, as Chris said, it's really all about financial planning for engineers. And we're going to talk about need for financial planning, key concepts, practical tools, and then really just planning for the future. So this is kind of that formal agenda. And we're going to spend most of our time, we're going to make the case for planning, and then we're really going to get into some application in these fundamentals, because we want to make sure that you understand the basics. Like, why do you need these things? And it's something as engineers, we're taught a lot of math. I remember going through the curriculum and I was like, oh my goodness, like, yay, more math problems. And it felt like I was really good with these things, but there's some finer details when it comes to the personal side of finance and numbers that we all need to make sure we're paying attention to. All right, well, let's start with the need for planning. Why personal finance? Why are we even spending quality time taking a look at this thing? Well, number one, blatantly, it has a massive impact on your life. I like to ask everybody, usually like when we're doing in-person seminars, like, hey, who does not need a paycheck? And there's very few people. I don't think anybody's ever raised their hand. And the reality is we all need money, right? We have to pay rent or a mortgage. We have to buy food or get food somehow, clothing. Like, none of us can function in this world without money. The problem is there is a lack of standardized education related to personal finance. I think there's 23 states in the US that require personal finance to graduate high school. Up until a year ago, Florida wasn't one of them. It is now, and they're starting to build out some curriculum, which is wonderful. But the reality is there's not a standard thing that we need to go through. There's an expectation that people need to learn, and we're somewhat left to winging it on our own. If that wasn't bad enough, there's a tremendous amount of noise out there. I'm sure you can go onto any social media platform and someone will be more than happy to give you their opinion about money and what you should or shouldn't do with it, whether it may be good for you or for them. And it's that challenge of going, okay, there's all this noise. how do I filter it down to good information? And of that good information, how do I find the stuff that's really going to be useful to my situation? And then the last piece of when it comes to the case for this is the outcome or the negative outcomes when we don't know about personal finance. Debt, we know there's a debt crisis with student loans. Credit card debt is increasing. Our country has a problem with debt, and we need to know how to handle that responsibly before it gets out of control. It's still, money is one of the top 5 reasons of divorce in the US. And then stress. Another question I like to ask people is, anybody ever stayed up at night thinking about money? I know how I have. Like, it's real. These things happen to us. And let's go into, as engineers, we like the numbers behind it. Let's dig into some statistics behind this thing. 2 out of 3 Americans in a recent study, I got the link there. You can go to it later. We'll send out a slide deck like Chris said. 2 out of 3 Americans are more worried about running out of money than they are death. And then 70% of Americans worry that their 401k or IRA savings, let's just call it savings, are going to be negated by inflation. Like, we hear inflation, like, is my buying power going to be where I need it to be to make sure that I can buy the stuff I need? And then if that wasn't bad enough, that less than half of retirees understand the appropriate way to leverage a taxable account versus a tax-free and a tax-deferred account. So there's just a lot of these, every industry has its jargon, just like somebody talking to an engineer isn't going to know the difference between statics and dynamics, the friction ratio, and all of these different things, factors of safety. The financial industry has that same jargon, and it's navigating what some of those things are. And part of the purpose of today's presentation is to make sure that everybody understands the basics of their finances and to then come up with a plan that's right for them. I like to look at, let's start with like life. And I like to break it down into events and journeys. Like, we, in this little graphic here, like this plane, we start out life, we're on our bicycle, and we're just going to go straight through the finish line, and it's going to be over at some point. And the reality is, that's the journey from when we start to when we finish. And then sprinkled throughout that journey are all of these different events that are going to happen. And it's kind of in that cartoon below, like, there's a lot of fun that happens through the events. There's a lot of dangerous situations. There's a lot of excitement. And it's navigating each one of those intentionally when it comes to our plan so that we can make the most of our journey. And as far as the events planning in the financial journey, I kind of tie it back to the old engineering problem. Anybody hopefully doesn't mind that I have an engineering problem on here, right? You have some kind of given. We have to find something, and then we work out the solution, which is always predicated on some number of assumptions. And then we check to make sure everything is done accordingly. Full disclosure, that is actually not my math problem. It was actually a friend of mine's who was sharing some help with me back when I was in college. Anyway, when it comes to the personal finance side, we can actually kind of tie events back to solving an engineering problem. The given is your goals, your values, your budget. Like, okay, well, these are the things that we know are important. This is the money we have to work with. And then we're trying to solve for some event. Maybe it's college savings, Social Security selection, funding retirement. I mean, you could put a myriad of these events in there, the events in there that we're trying to solve for. And then the solution comes up with, okay, what's the cost required? How do we come up with the appropriate savings vehicle to make sure that we're attacking this thing most efficiently? And usually there's more than one solution that's going to work out. And on the financial side, it's a function of what are the assumptions? What are the costs? What's rate of returns? What are savings rates? What are timeframes? And you're going to see that later on in today's presentation, that the assumptions are huge. And we can argue about some of the assumptions, and I'm happy to do that or discuss them, not necessarily argue, but we can certainly discuss these assumptions because they are important and walk through that to say, hey, what's right, what's not. And then that final check as we look at the events in our lives is to evaluate those in light of the ongoing journey, right? Like, when we look back, we want to make sure we accomplish the things that we set out to do and had fun doing it along the way. All right. Before I jump into this, so engineers, right? We're all rational decision makers. Like, we know that, right? We're taught that. We can solve this with a calculator and a piece of green paper. Reality is none of us are. Take a look at these two tables. You're going to have the slide deck later. You can do this exercise. Don't think about it. Are they the same shape? Not same area, not same perimeter. Like, are they physically the exact same shape? Well, I kind of queued you up on this one, right? You're going to go, well, I feel like the answer should be yes. And the reality is they are. That said, I can look at those two tables because I know the answer. I've cut out the pieces of paper and had my boys do it for a fun exercise because they didn't believe me either. But my brain tells me they're not. And it's an optical illusion. And that has to do with the fact that the human brain does not make rational decisions. We want simple solutions to things. Now, in school, engineers, we are taught to dig into the details to make sure that the math works. But that doesn't mean that in life, we still don't want things to happen very, very quickly. And then there's these two behavioral psychologists, Daniel Kahneman, and the other gentleman's name is escaping me right this second. But they wrote this book, Thinking Fast and Slow, and they talk about all these heuristics and these biases that we have in our minds, and they break it down into the fundamentals of system 1 and system 2. System 1 says, oh, I don't want to spend a lot of mental energy on this. I just want it to be easy and go away. System 2 says, hey, we have to get into some deep thought here to make sure we're making the best decision. It's going back to the table, right? Like, I want this to be easy. It's clear they're not the same size. Keep on moving. System 2 goes, let me measure out these dimensions, verify and check. And I'm going to find out that system 2 is wrong. And I say all of this as just a preface to go, hey, when it comes to financial planning and to financial decision making, we have to pay attention to the details. Every one of us has to do that. And in that quote there from Tony Robbins, that complexity is the enemy of execution. When it gets to that system 2, we tend to want to run away from it and go, maybe I just won't do it, or I'll come back to it. And that's what we don't want to do. We want to make sure we're paying attention to it. So it's going to take a little bit of effort. And if that wasn't bad enough, money's emotional, right? Like, when is the last time, Chris, when's the last time I came to you and I said, hey, Chris, let's pull out our paychecks and compare these?
I think it was like last week, maybe.
Okay, well, we're in a little bit different boat, right? Maybe, hey, how much are you getting paid? How much are you having withheld from taxes? How much are you getting as a tax refund? Should I get a tax refund? Should I owe the IRS money? How much are you putting towards savings? What's the right amount? Does the company offer any way that I can save for my college future? Like, these are conversations we should be having, but we don't, because money is emotional. And that's okay, because emotions matter. But we have to understand that that has an impact on what we are doing. And just because it's going to be difficult, system 2, and it's emotional, doesn't mean that we shouldn't talk about these things. We need to have clarity on our numbers and learn about this stuff so that we're making decisions in line with the things that are most important to us. All right, well, let's get into enough of concept. Let's get into, okay, what are some fundamentals of, okay, you've got me. I want to know more about financial planning. What are some of the fundamental pieces of a plan? Well, number one, it's going to start with what's important to you, right? They use the word personal for a reason. It's specific to you. It's about what matters to you. It's your life and the things that are important to you. And so that starts with, do you have goals, right? Is it, hey, I want to finish college debt free, or I want to buy a house, or I want to save for my kids' college? Like, these are all, I want to travel and just have some awesome adventures in my life to do these things, because what's important to you isn't important to the person next to you. And it is specific to your goals and then the things that you value. And if you don't know those two things, all of a sudden we can start making emotional decisions when it comes to money. And we would rather you say, these are the things that are important to me. This is what I value. And then we can, emotions are on our side. Because all of a sudden, if this is a goal and it aligns with something I value, I'm going to be emotionally involved to go, I need to get into this to make sure this happens. Like, get in and understand how you can do the things that are really going to make the most impact in your life. I like to break down, let's keep it simple when it comes to personal finance. We're going to start with offense and defense. Offense are the things that we do to control, or the things we can control to acquire and grow money. And that's what we do through our businesses, investing, savings, etc. And so I include into those, okay, what is our income? What are we saving? What are we investing? So if we don't have income coming in the door, well, then we have a problem. We already talked about, like, we all need some level of money to be able to function in our lives. And then once it comes in, what are we going to divert it to, right? If you think of, money coming in the door as this big pie chart, 100% of money coming in the door, how much of that pie do I want to go into savings? How much of it do I want to go into fun? How much of that do I want to go into real estate? I mean, you can name all of these different things that ultimately are contingent on the things that are important to you. The other piece is the defensive side. So these are the things that we do to prevent money from leaving our possession. And again, we don't want it leaving our possession on things that aren't important to us. And that includes budgeting. I know that's a taboo word a little bit. Call it a spending plan. It's your money. Direct where you want it to go on the things that you want it to go to, not just what we've maybe been driven to emotionally to do. And then reducing debt. We're not going to talk a ton about debt today, but when we're paying out high interest rates to people, we're losing the opportunity to earn those higher interest rates. Another one is tax planning. That's probably one of my favorite pieces. Is in the tax game, what are we doing to legally pay the fewest dollars towards taxes that we have to? I'm not saying skirt the government their money, give them what they need to operate, but none of us get a gold star for overpaying the government in our taxes. And then the last piece of this is insurance. Like, when it comes to financial planning, you need to understand the role insurance plays in your plan. Do you have the right risks mitigated when it comes to your insurance? And there's all kinds of insurance you can buy out there, and we'll talk about those here in a little bit. But these are the defensive side of when the money comes in, where is it going to, and understanding how it's being applied to the things that you want to do. All right, let's talk about net worth. So we had offense, we have defense. Now we're talking about net worth. And if you don't know what this is, I got the equation down here. It's net worth is equal to the assets. So assets are there on the left in the table. These are the things that we own. Think property, retirement savings, vehicle, cash, jewelry, crypto, all of the things that we own. And then on the liability side, it's the things that we owe money on. If we have a mortgage payment, if we have credit card debt, student loans, vehicle loans, other debts. So it's really a function of debt. So if you're renting and you pay your rent, that's not a liability. That's just an expense. It's something that we owe money on to ultimately own ourselves. So we can add up all the things that we own. We subtract all the things that we owe money on, and that is our net worth. Now, there's not necessarily good numbers and bad numbers. Generally, we like, well, okay, if we're negative because we owe so much money to a lot of people, that's a problem that we need to fix. But once we start getting positive on the net worth side, that number is specific to you. Is that number going to allow you to fund the things that are important to you? Is it going to allow you to do the things that you want to do either now or into the future? And understanding the trade-off between what value does owning things provide versus is there value in things that, I owe money on? Can't answer that question for you, but I can challenge you to learn about the trade-offs there. Like, personal finance is a skill that can be learned, and knowing how you build habits and systems towards the things that you want to do. All right, so we have those big picture concepts. Know your values and goals, have a good offense, have good defense, and then know your numbers. Like, know your numbers, know your net worth. Is it going towards where you want it to be? All right, so let's get into some application here. I like to break. So we started with the journey, and we said, hey, there's the journey that start and finish, and then there's all these events that happen throughout life that are planning opportunities. And the IRS does us a really big favor by telling us what those static events are. And there's 15 highly predictable regular dates across your lifetime that the IRS says, hey, pay attention. This is a financial planning risk or opportunity that you need to consider. You can see on the left-hand side of that chart, a lot of it starts from 0 to 26, right? On the front end of life. And then a lot of it happens from 50 to 73 or 75 on the back end of life. So we have these planning opportunities at the beginning. We have these planning opportunities at the end. And you're like, all right, well, great. I'm in between 26 and 50. Great. I don't have to do anything. I'm good to go. Well, the reality is you probably are getting sandwiched in, and you probably have kids that are coming up through the beginning. And likely you have aging parents that are going through the gauntlet at the end that you have to pay attention to. And if, to put a little more weight behind that, is that those items that you're going to be looking at coming at you in your 50s, 60s, and your 70s, you hedge your bets a whole lot better starting to look at those in your 30s and 40s versus waiting to get there, right? And as engineers, I think most of us understand the proactive need of planning. Like, let's avoid the reactive unless we have to, right? Shoring frame breaks, forms blow out. That's clearly reactive. The better way is to be proactive and go, hey, we designed this to make sure that there isn't going to be a failure, or anything that we have a reasonable expectation of having a failure. We've gone ahead and shored up or planned for that. And there's these 5 overarching constants that kind of hit any of these 15 predictable dates: savings, investing, taxes, insurance, and estate planning. We're actually going to talk about all 5 of those today, like do a little bit of looking under the hood of those. And these are the static ones, right? It's just like when you were going through engineering classes, you went through statics and you're like, this is, or the instructor's like, this is easy, nothing moves. And you're like, yeah, I got this. And then you go to dynamics and like, forget everything you learned in statics, everything moves. And you're like, what do you mean? Well, that's what happens on the planning side. There are those static items that happen, but then there's the dynamic one. Now, we still have those overarching constants of savings, investing, taxes, insurance, and estate. But these life events listed here, we don't know when they're going to happen on your timeline. Take starting a business, for example. You could do that in your 20s. You could do that in your 60s or later. Selling a home, that can happen multiple times throughout your lifetime. Buying a home, the same thing. Kids heading off to college, a job change or a job loss, moving to a new state. Like, these are things that we have a reasonably high expectation that they are going to happen. However, we don't know when exactly they're going to happen. All right. Well, like I said, we're going to get into each of these 5 overarching constants, starting with savings. I think the fundamental question when it comes to savings is, what's enough? Is a little bit enough? Is kind of in the middle enough? Or do I need to start saving more? And the answer is, it depends. And it depends on the individual. It depends on the person. And I'm sure you're thinking, wow, Stephen, that's super helpful. All right, well, let's put some actual pen to paper on that says, how much should I save? General answer, if you've put me in a corner and made me give you a number, 15%. Now I put a thing on there, it says or more, and it depends on when you start saving. And we're going to look at some examples of that here in just a minute. But if you saved 15% every day of your working life, you would not have to worry about building wealth and doing the things that you want to do later in life. The challenge is that's a lot. And so what I would say is start incrementally, start small and move up. Hey, if we're at 0, let's get up to 2%, then to 4, then to 6, and make it over a 1 or a 2 year window versus going, oh my gosh, I'll never get to 15%, so I'm just going to quit. There's that system 2 coming at us. The other piece of this is leveraging payroll deduction to automate the savings. So if we're putting, if we're putting 5% in towards savings and all of a sudden I get a nice increase in my salary, My savings also went up. Percentage stayed the same, but the actual dollars that go into the account move up from there. As far as where to save, I like this chart because it talks about some of the priorities, like where do we start here? Number one, we're going to challenge everyone. Do you have an emergency fund? If something happens to you and you're unable to work, do you have money set aside that you can use to pay the bills, keep the lights on, and the like? It's going to range depending on the stability of your income and what kind of industry you're in as to whether 3 or 6 months is the right number for you. The next rung is go for the matching dollars. So if you have a health savings account that you can contribute to and get the match from your employer, great, that's free money. Anytime you see the word match, your brain needs to go, free money, how do I get it? And it's the same thing to your retirement plan. Let's say your company offers a 401k and there's some percentage match. Like if you put in money, they'll put in money. That's a really good deal for you. So we like to target getting in and saving in vehicles where we can get a match to start building up that 15%. And then we need to start looking at higher interest loans. Like, do we have debt out there? Rule of thumb for this, again, assumptions, 6.25%. If you have debt that's got a 6.25% interest rate or higher, we need to look hard at that. Mostly is going to be credit card debt. Like that's where you're going to see those high interest rates. Sometimes it's going to be mortgages lately. And usually student loans are going to be a little bit lower there, but that's what we would recommend there. Once we've got rid of high debt, then we can start going, hey, can we do additional funding into a health savings account or some kind of retirement vehicle? Then we can start paying off additional debt. And from there, we can look at some other savings vehicle, whether it's an IRA or a taxable account. If you don't know what any of these accounts are, don't sweat it. Reach out to us, send a question or send us an email after. We'll go into all the details of it. But for time's sake, I don't have a chance to jump into all those, but that's kind of our savings hierarchy. Because I wanted to move on into, okay, well, still, you said 15%, you gave me a hierarchy, like how much should I have saved? Am I on track or am I off track? So I love these next couple slides that give us some savings checkpoints, because what we can do here is we can look up household income. So I'm going to take, for example, let's say household income is $60,000 and today I am 40 years old. I would want to have approximately $85,000 in savings today, so that when I stop when I stop working at age 65, that I can use my investments to then pay myself my same 60,000, right? The assumption is I'm going to want the same income coming in today that I'm going to want to come into retirement. And you can see here, a lot of the model assumptions are over here. 5% rate of return, diversified portfolio with its allocation pre and post retirement, what inflation looks like, retirement ages, and then how many years in retirement. And this is a big one, right? Like when you retire, 35 years potentially in retirement, I'm going to need to draw income. I saw a thing just the other day that there's this, it's called survival pessimism, that a lot of people get to retirement. They're like, there's no way I'm going to live that long. And the reality is there's a good chance you could live that long. So you want to make sure that you've prepared for the worst. And as engineers, we get that, right? Like, why can I only use half of the compressive strength of that concrete? That seems ridiculously conservative. Well, what happens if it fails, right? We never want to find ourselves in that position. Like, what if we live longer than we expected? Do we run out of money in retirement? We saw that. A number of Americans, one of their biggest fears, I think it was 2 out of 3 Americans, fear running out of money before they die more than they do death. I have another slide of this same information on here with different household incomes. So definitely find out where you're at. And this is a call to action. If you're ahead of savings, great. That's awesome. If you're behind, okay. Now we know where we're at and we need to try to go ahead and do some adjustments and some tweaks on this. All right, I want to go ahead and shift to that next overarching concept, number 2, investing. I'll keep this pretty simple. Like, what are some keys to investing as we see them? Well, number 1, you have to save to be able to invest, right? If we never save anything of the money coming in the door, we can never divert our money into investing. And for most of us, it's going to be into our retirement plan. So everybody in the audience, raise your hand if you are contributing to your retirement plan. All right. Now keep your hand up if you consider yourself an investor. Everybody's hand should be up. Most of us are going to be investors. Well, all of us, if we're contributing to our retirement plan, you're an investor. And sometimes there can be a disconnect there. We're like, oh, well, I'm just putting into my retirement plan. Well, that money's invested. If you go look at your statement, you can see what it's invested in. And that makes you an investor. So we want to make sure we're savings to invest. And then we want to be cognizant of taxes and fees. And so these are going to be costs on the savings that can reduce our return. Inside of a retirement vehicle, these fees are usually very, very small. So I don't think you should be too concerned about that, but you should be able to find all that information in your statement. We are big proponents of staying diversified. So not just do a single stock pick and hope that GameStop's never going to come down off of its high, right? How many of us remember that? There was a huge crash there, or hope that Tesla is just going to keep going. We don't know what these individual companies are going to do. But statistically, when we put our money across a lot of different companies, then we've hedged our bets. So like S&P 500, those are the 500 of the largest companies that make up that one index across all. Now, for those of you who are nerding out on the Magnificent Seven, Chris Cotton will be happy to have that conversation with you later. Hit him up on LinkedIn or Twitter or anywhere else. And then also lastly, maintain a long-term focus. And that's understanding that you do have to embrace risk. Investing is not, hey, this is going to pan out for me tomorrow. So in the little sketch we have here, like days, our investing balance can go up and down. That's volatility, but we need to step back and you take a big picture look over decades, what the markets have done is they have gently moved up and to the right. And that means that your money is growing and working for you. I love the quote here from Warren Buffett. It says, investing is simple, but it's not easy. Like, oh yeah, you just put your money in here and let it work for you. That's the simple side. But that emotional side, the money's emotional, that's where the easy part comes in. So let's talk about compound interest. And let's look through a couple of examples because I think this really drives the point home. This is an example of how compound interest grows over time. So it says if we were at year zero to put $10,000 into a savings account, we just left it there for 30 years, technically the balance would still be $10,000. Well, you wouldn't have buying power of $10,000, but the number would not have changed. If you put that same $10,000 over a 30-year period at a 5% annual rate compounded in 30 years, instead of being worth $10,000, it would be worth over $40,000. So your money would have made you over $30,000 by just leaving it there, invested in doing its thing. And we're big proponents of it's about time in the market, not timing the market. The power of compound interest means putting my money in there and letting it work for me for a really long time, not trying to jump in and jump out. This isn't Vegas. We're not going for quick wins here. We're going for the slow and steady wins the race when it comes to investing. All right, let's look at another example. And I really love this one because I think it tells another powerful story. We got a chart here. It gives monthly contributions anywhere from $200 to $600 a month, and then over what period we make those contributions. And then the chart off to the left shows the 30 years at $400 a month. So in a 30-year period at $400 a month, our balance would be approximately $490,000. So we wake up one day, 30 years later, we look at our statement, we're like, oh man, my $400 a month turned into $500,000. This is fantastic. That is fantastic. But I think what the most impressive part of this is, yep, we started with an initial balance of zero. We contributed $144,000, not bad by any stretch of the imagination. But the growth was $343,000. So yeah, we contributed this, but then our money made us this much. And I think all of us would agree, like it takes work and effort to earn money. And investing allows our money in return to work for us to make us more money that now we're not having to work hard for. So putting our money to work as hard as we do to earn it. I do have assumptions here. It's a 7% rate of return. Again, we can discuss these, but it's and get into the details. But it boils down to, did we put the money in consistently such that it got a rate of return that was positive? All right, next overarching concept. We talked about savings. We talked about investing. Let's talk about taxes. As I told you guys earlier, I love taxes. The engineer in me, it's just a bunch of detailed numbers, digging in and looking for opportunities. And the goal when it comes to taxes is keeping the lifetime tax liability as low as possible. And sometimes, certainly, it can feel good in April to get that nice check from the IRS. You're like, oh, yeah, refund time. Let's go have some fun. The reality is you just gave the IRS an interest-free loan for the past year, right? That's money that you could have saved more, you could have traveled, you could have done a lot of different things throughout the year, but you gave that money to the IRS. And I'm not saying you shouldn't get a refund. Please don't hear that. But I just want you to have that awareness, like, hey, should I let them hold all that money for me? Or conversely, maybe we owe them a lot of money and we're not paying enough into taxes. And you do not want to owe the IRS any money. They can garnish your wages. They've got the full power of the government to come after you. And it's finding that balance of going, hey, what's the right amount to put in versus withhold? And I think when it comes to taxes, it's really, really important to understand there's two distinct taxation levels. There's short-term, ordinary income, marginal tax brackets, anything that we earn inside of a 1-year period. That can be our W-2 wages. That could be earned income from work. That could be a 3-month CD throwing off interest. If we get the money, we make the money in less than a 1-year period, they're taxed at higher marginal tax rates. If we hold an investment for more than a year, then we get what are considered more favorable long-term capital gains rates. So all else being equal, if I can pay fewer taxes by deferring the income for more than a year, I'm coming off in a better situation. Now, sometimes we can't avoid that, but it's at least worth understanding that, hey, how do I make sure that I pay the fewest possible tax dollars? All else being equal, if I had some stock options at my company that would either be ordinary income or long-term capital gains, I'd rather have long-term capital gains. How do I do that? I think most of us know that, like when it comes to housing. When I homestead a house and I sell it, the capital gains on that, as long as it's not $250,000 per person or $500,000 per married couple, I think those are roughly the numbers. We don't pay taxes on that. And that's one of those things going, how do we make sure and understand the implication of a decision when it comes to the tax side? Best advice I can give all of you today is the two most powerful for most people is contributing to your retirement plan. When you contribute to your retirement plan, it reduces your taxable income. So if I make $10,000, I put 2,000 of that into my pre-tax 401k. The government only taxes me on $8,000. The other one is if you have a high deductible health savings plan and your company provides that health savings account, which we talked a little bit about earlier on the savings vehicle. Same thing. If I make 10,000 and I put 2,000 away into my health savings account, now the government only taxes me on $8,000. So little things that we can do to reduce taxable income. Now, it can be more complicated than that with what's your marginal tax bracket? Does pre-tax versus post-tax matter? I don't want to confuse anybody with that today. I do want you to be aware that those are out there and there's some more nuanced pieces to it, but there is a way to reduce taxable income. And again, saving for the future helps both with the savings component and the tax side. If you fast forward onto taxes into the future, there's definitely some charitable giving strategies and some Roth IRA conversions that you can think about in years ahead. But this is where that planning side goes. Like, what do I need to do in my 30s and 40s or possibly 50s before I get into my 60s and 70s to beat this lifetime tax game. All right, next, insurance. I have a love-hate relationship with insurance. I love the protection it gets, but I hate paying the premiums. And so that's where insurance happens. Like it's this thing of going, am I willing to pay a little bit of money over here to transfer risk? Insurance is transferring risk. When I buy auto insurance, I'm transferring the risk of me getting in a wreck and having a large medical or legal bill that has to get paid. Now the insurance company is going to handle that and I don't have to worry about it. So I pay a little bit in auto insurance premium and they take the risk of some big loss on the back end. It's important to understand that insurance is a product. And I think for any engineers in the audience who are also in construction, you understand the concept of selecting or soliciting competitive bids for services and getting multiple bids to go, hey, are you getting the best value for your dollar? So annually, that shouldn't say biannually, it should say annually. You want to make sure you're shopping your home insurance, your auto insurance. Like, is there a better rate out there? Because they have their actuaries calculating, hey, this is the time, this isn't the time, we're going to lower rates on this to try to bring in new clientele. So we have to make sure we're doing that. Then you can always look at bundling coverages. The problem with bundling, though, is you don't want to bundle and then you're tied in with somebody. So you still, even if you bundle and you say, hey, I'm going to do my home, my auto, and this other piece with you to reduce the cost, just make sure you can't, independently get those from different vendors at a lower aggregated cost. As far as recommended policies, we certainly love to see, we are fans of term life. So if somebody depends on your income, that could be your spouse, that could be children you take care of. Somebody depends on your income. How are they going to get your income if you're not here? And that's where term life comes in. It's very inexpensive. Well, it's relatively inexpensive insurance with a big payout over a very fixed period of time, usually like 10 to 12 times income. So if I make $100,000 a year, I'd want somewhere between $1 million and $1.2 million in term life insurance so that my spouse, if I'm not here anymore, now they have this money that they can invest and live off, and they can replace my income so they don't have to worry about moving or changing schools or, lowering life, quality of life and these other things. And it doesn't ever replace you, but it will at least make sure your family financially is going to be okay. Everybody needs to have auto insurance, homeowners insurance. And when it comes to those two things, like liability limits are important. So you have to pay attention to the details there, because we don't necessarily want the cheapest thing. We still have to shop it to get the best value, but we don't want to cheap out on liability and then still have a hidden risk there. We also recommend health insurance. We like long-term disability insurance. I know engineers, a lot of you can get it through ASCE and some of these other organizations that if I'm injured for more than 3 or 6 months, how does my income get replaced? And that's where long-term disability steps in. If you're in your mid 50s, we like long-term care insurance. It says, hey, if I have to go into some kind of assisted facility or my spouse, will insurance pay the premiums there? And then the last two, identity theft insurance. We all know we live in a cyber attack world. If we get hacked, what's going to happen? We like the identity theft that gives you a case manager and monitoring and some limit policy of damages if they happen. And the case worker on that's the most important, because the headache when it comes to identity theft is all of a sudden, I have all this, I have to file a police report, I have to call these companies, try to do X, Y, and Z. Now I can delegate it to the case manager and just say, hey, please tell me what you need me to do. And then we keep on moving. The last one I want to explore for just a second is umbrella. If you've never heard about it, you have your home, you have your auto, and then the umbrella sits on top of those two policies so that if we exceed those liability limits of the home or auto, the umbrella policy steps in and pays anything the other two didn't. General rule of thumb, again, we talked about knowing your numbers. If your net worth is over $500,000, you should look at an umbrella policy because that's when attorneys are going to start sniffing around on those things. All right, last overarching concept that really applies to everyone, depending on, regardless of where they're at on their journey of life, is your estate plan. Whether you have been intentional to develop a will or not, you have a plan, and that's you're letting the state, if you're in Florida, the state of Florida, figure it out. So a judge is going to go, okay, for this person, they left me no instructions on where they want assets. So I'm going to do my best to figure out where I think they would have wanted them to go. They may get it right. They may not. What a will does is all of a sudden judge says, oh, Chris wanted this to go here and this to go here. And now the judge goes, yeah, I know exactly what this person wanted. Thank you for the instructions. So everybody over 18, we're big proponents of having a will. And then you need to have financial and healthcare power of attorney, or what's known as a healthcare directive. And what these two things do that says, hey, if I'm incapacitated, who can make financial decisions on my behalf? Who can access my accounts to pay the mortgage, pay the utilities, pay the nanny to make sure life still goes on while I'm recovering? And then also who's making healthcare decisions? Do I want, slightly obscure Uncle Bob, or do I want medical doctor Susan? I'm going with Susan. Like, I want to pick who's going to make my medical decisions for me. And the other piece with that is verifying your beneficiaries. So inside of your retirement accounts, any life insurance policies you have, checkings or savings account, you need to make sure that the beneficiaries are who you want. We were just talking in the office the other day. There was an ex-spouse on a client's retirement account. That was a real problem because that wasn't who it was supposed to go to. And they're not going to budge on those kind of things. So you have to make sure your beneficiaries align with who you want to handle your affairs or who you want it to go to. All right, let's talk about some action steps as we kind of wrap up here towards the end. And it's just establish a plan. Like, it's called financial planning for a reason. You have to have a plan. And for engineers, anybody in construction, we get this, right? Municipal infrastructure, the commercial buildings, all of these different things, roadways, they don't just happen. It's not just, hey, we're going to go out and build this thing and we're going to hope for the best. There are years, if not decades, of planning that go in to coming up with a plan of how construction is going to happen so that it's designed safely, it's built correctly so that it can go into service. And it's not just, hey, let's do this thing because it's going to look cool, but it takes a lot of planning. And we know that nothing ever goes according to plan. There's always, oh my goodness, this was put in the wrong place and we have to adjust it. And so that has to happen to the same thing in our picture. It says, hey, what's our current reality? What are our goals? And then we course correct over time, like where things are going to go. And it starts with what's important to you. What do you value, right? It's your life. It's your plan. Once you know the things that are important, you can piece out a plan that aligns with all of those things. And yeah, things are going to change, and that's okay. But Gene McCowan in his book, Essentialism, said, if you don't prioritize your life, someone else will. And so for us, we want you to prioritize your life to the things that you want it to go to. Like, that's what's important. And I could go on to the benefits of financial planning and talk about savings and all these rates of returns and all this stuff. And yeah, those are really important. The tangible, the tangible side in the numbers. Yeah, that certainly has value. Please don't hear that it doesn't. But when it comes into peace of mind, knowing that you have a plan for the unexpected, clarity so that you know that your financial objectives are where you want them to be and there's not any confusion or uncertainty around those things, confidence, walking towards something that you know you've built out that's important to you. And definitely, we talked about this at the very beginning of presentation day about financial stress and staying up at night and going, hey, we don't know everything that's coming at us, but with a well-crafted plan, we can certainly decrease the stress that comes from not having a plan. I do want to kind of just put this out there because I think it's important. Everybody on the call today comes from different backgrounds and different timelines. And yes, Chinese proverb says the best time to plant a tree was 20 years ago. The second best time is now. And so there's never I started too late or I started too early. It's your life. Start now. And if you haven't been planning, that's okay. Go ahead and jump into it, because the important piece is that you start. It's not going, hey, I'm just not going to pay attention to us. The future is going to come at us, and we want to go ahead and start versus getting 5 years down the road and going, probably shoulda, coulda, woulda. So definitely go ahead and make sure that you're jumping into it. If you don't have a plan, there's a tremendous amount of resources out there. Some of those I'm actually going to share with you today as we wrap up. We will send out, so as Chris said, excuse me, after the presentation today, you will get a Google form with, we need your PE number, answer a couple of questions. We'll get those certificates out to you. With those certificates, we're going to go ahead and send out a master list of goals, which just, it's a brainstorming tool that says, hey, is this important to you? Yes or no? Okay, well, that, just to try to filter down the what's important to me. Like, what are the things that I want to do, and what are the options? The other is those important milestones. I gave you all the 15 things that the government says you better be paying attention to. I feel like I'd leave you hanging if I didn't tell you what those were. So that important milestones has at each of those dates what those are. And for those of you who want to know more about planning and just, you're like, yes, I need to do this. I love these books. I've read all of them. I believe in all of them. They can give you a tremendous amount of resources when it comes to planning. Certainly, we do that for individuals as well. But if you want to know more and just self-educate, please check these out. That last one's really not a financial related planning, but if you like the behavioral psychology side, that Thinking Fast and Slow book by Kahneman is fantastic. All right. Disclosures, our lawyer says we need to put these out there, and for good reason. We are highly regulated by the SEC and FINRA, as we should be, and we want to make sure that everything that we put out, we believe, is free from error. That said, we can't guarantee it, and we just want to have full transparency with you from that side. All right, Chris, wrapping up. I'll turn it over to you in just a second. If you haven't already connected with me on LinkedIn, please check me out. I should have, Chris, thrown you on here as well. I'm sorry. I'll update that slide and we'll get you going on there. Check us out on LinkedIn. We put out our content on there, YouTube, Facebook, and Twitter. So feel free to reach out, find us any way we can. We love talking about this stuff, putting education out there for each and every one of you, and appreciate your time today. All right, Chris, I think I stopped the presentation.
Yeah, very good. Thank you so much. Thanks for that presentation, Stephen. It's nice to kind of walk through financial planning and what are the actual steps. What does someone go through when they do financial planning? We're going to open it up to Q&A. We have just a few minutes here, but as folks are potentially getting those questions in, I'm going to ask you a few of my own, if that's all right.
Yeah.
So you talked about a real world example when we did an estate plan for somebody. They had something set up prior, and we helped them work through a resolution. Can you give us a real world example, maybe your favorite one, leaving names out of it, where we help somebody with their taxes, something we did for them in their tax life that was a problem?
Oh, fantastic. So we got another 3 hours to do this thing. Let's go.
Yeah, all right. No.
Taxes, again, they change every year. We are not attorneys. We don't do tax returns. We don't want to do tax returns. Tax accountants are being very, they're backward looking a year. And so we're from a forward looking, like, are there opportunities here? A couple quick wins. Had a business owner. He has a coaching business. His wife has an event venue, very intelligent, sophisticated, wonderful people. We start looking at their taxes, and we're like, okay, you have this business as an LLC. And he's like, yeah. And we're like, why aren't you filing as an S Corp? He's like, well, my tax accountant hasn't told me to. And we're like, well, you need to consider this because of X, Y, and Z. Punchline was, it saved him $15,000 a year in taxes in year one, and then every year thereafter. Another quick one is somebody, the threshold increase for how much they can contribute to their retirement savings. Well, now all of a sudden they were in catch-up contributions, and they didn't realize that they could actually contribute more to their retirement savings, and they thought they were fully funding, but they weren't. So I think those are two top of mind, definitely that we've seen recently.
Yeah, I remember those. Those are good ones. And then one last one, open enrollment's coming up right on the 15th. So if someone's potentially thinking about retiring or is retired, and maybe more poignant for folks on the call if they're in a group plan? What should we be thinking about as we head towards open enrollment?
Yeah, certainly health benefits are necessary, I think, for most people without knowing your unique situation, but assuming you're in pretty good health, look for a high deductible plan. And then you can tack on a health savings account. And I would say if you're going to do the high deductible plan, you need to open the health savings account and you need to fund it. I think as an individual, you can put in $4,000 this year, $8,000 as a family, and there might be a little bit more with catch-up contributions. But you can fund that account today and then use those dollars. You can use them for dental, vision, copay. You can use them for over-the-counter stuff at Publix. Like there's a mass Tylenol, ibuprofen, all of these different things. So any money that we put into the HSA is immediately available for health expenses and it doesn't get taxed. So we're actually using tax-free dollars to use that. And if we don't spend it inside of an HSA, it rolls over from year to year to year, and you can actually invest those dollars as well. And then just be aware of supplemental coverages. Those are all products, and that doesn't mean they're a bad thing, but the question that you need to look at is, do they deliver value to you? Are those supplemental and policies really going to put more dollars in your pocket than they cost you? And gauging that risk versus reward.
Hey, those are great. All right, folks, I think we're running up on it. So as we mentioned, you'll receive today's webinar recording along with a copy of the slides, and that CE quiz will be sent to you all via email, so keep an eye out for it. You'll get the certificate within 5 business days of you submitting that quiz back to us. Once again, thank you all for your time and participation. Have a great rest of your day, a safe and dry week if you're here with us in Florida, and we look forward to seeing you in the next webinar.
Thanks, everybody. Have a great one. Be safe.